grew up in a household where we didn't have very much money. And so therefore we didn't talk very much about money. My parents never brought up the subject of money. So I want to ask you guys, what are some money beliefs or some memories which you grew up with? If you guys don't mind, maybe like putting in the chat room, or like if you don't mind talking, just raising your hand and I'll call you, and then maybe you could share something with us. So I'll give you a few moments to actually put something in the chat room or something. Oh, thank you, Aubrey. I remember cutting coupons with my mom. Yeah, I cut coupons too. Okay. Oh, okay. Money turns people evil. Thank you, Miro. Please restate the question. Yes, Dan, I'll restate the question. So, the question that I'm asking is, what are some money beliefs that you grew up with? They could have came from your early childhood memory, or maybe it could have came from the way your parents managed money or things like that. I mean, like, what are some money beliefs which you grew up with? Thank you, Amanda. Only buy what you can pay for. Buy a home, don't rent, and also must always work hard. I grew up with a family that believed we would just make it work. There was not much to go around, but somehow it was always there. That's great. A lot about savings. Cash is best. I heard that too. Money was always tight growing up. I remember it being a stressful topic. Money changes people. Thank you. Daniel said, don't buy what you don't need. I completely agree, but then easier said than done at times. And also maybe that's some of my money beliefs, which I grew up with as well. My family believed work hard and money will take care of itself. My husband and I kind of had that belief too early on in our marriage. And so mother didn't know how to handle money. Father always operated with liquid assets, but expressed importance of credit. And Allison says, always put some amount away each month in savings. Well, these are really, really great comments. I mean, a lot of those comments really resonate with me, and I'm sure it resonates with many of you guys as well too. But at times, like especially if you grew up in a household where you didn't have very much money, oftentimes, we're raised with some limiting money beliefs and connotation, such as, and we saw that here in some of the comments, like, making money is hard, investing is just for the rich, or I can't save while I'm in debt, or that money isn't important. But then I want us to, I mean, if you grew up with some of those beliefs, I wonder if there's a way we could actually change those beliefs. So for example, like, what if you could change those beliefs about money? And then perhaps maybe we can make some changes to the way we actually spend our money, where we invest our money, and things like that. And so what are some opposite beliefs from like what you see up there? Like the first one says making money is hard. I think making money can be easy. Maybe making money can be fun, or something like that. Thinking opportunities. Thank you, Daniel. Or like maybe like for the one that says I can't save while I'm in debt. Maybe instead of that, maybe I could say something like, I have a plan to actually pay down my debt so that I could start saving. And then instead of saying money isn't important, I could also say like, money could help me achieve certain types of goals that I have. Yeah. Matthew says, money is a tool. It requires intentional care with the right skills can be used to work for you. Absolutely. And I think a lot of the times it's about changing our money mindset. But a lot of the times, some of the biggest mistakes the Americans make with their money is that they don't start planning early enough, or at least they don't start thinking about it until they're much later. So I want you to focus on these statistics here. I found this statistics from the US National Financial Literacy Education Commission, and it says that 7 in 10 Americans don't plan. And why? It's because they said that they just don't feel confident with these type of decisions, with financial decisions, or maybe it's just not the right time, or that maybe they don't have enough money to actually make these decisions. But what they also found is that through the research that if people spend time learning about financial planning, then they are 75% more likely to be confident about making financial decisions. And what the study also showed is that your level of income or debt is not the determining factor. And so I guess in conclusion is that education is important because financial knowledge creates confidence. And that's what we hope to do at the Center of Financial Wellness, is to give you the financial knowledge and skills so that it could build up your confidence to help you engage in new behaviors, which hopefully would lead to better financial decision making and ultimately an improvement in your financial well-being. So I really like this illustration. It says that life's journey is costly, but it is very costly, right? I mean, because there are a lot of different milestones that we want to achieve, or like certain types of goals. But not just that, this illustration also shows different life stages that many people experience, or like maybe will experience during the lifetime journey. And before I go any further, I just want to make a note here and say that this illustration is not the same for everyone, because I mean, your life journey may look completely different because I mean, you may have a different accomplishments that you want to accomplish. But like some of the milestones that we see here is graduating from college. Oh, sorry, my Alexa device is going off. You know, like maybe like college, maybe you want to get married. It's somewhere in your future, and have children, or maybe buy a house, travel. Definitely we want to plan for our retirement. But like even after retirement, we're going to find out that there's going to be costs associated with our retirement, not just our living expenses, but there's medical and long-term healthcare costs, which are very significant. So it requires a lot of planning. But then, you know, regardless of what path you take in your life journey, whether, you know, you do all of these, or like maybe you don't do this, and maybe there are other things in there. Most people who actually make financial goals and also learn to manage money well, they'll find that their wealth will grow at an accelerating rate over their lifetime, as we see here. And so we see on the vertical axis, we see savings and investing. And on the horizontal axis, we have time. And time, if you start early, is really an asset to us, because through time, we can make our wealth grow. And so if you're a student here currently, and you're just starting on your journey, I'm so glad you're here with us, because you really do have time on your side. And then later on, I will show you the power of compounding interest, which shows you why you have time on your side. Now, if you're further along in your life's journey, or maybe have not started planning, that's okay too, because you could start anywhere in this journey. Like, for example, my husband and I, we didn't even start planning or even thinking about planning until we had our second child well into our 30s. So the important thing is that you start, that you're here and you're here to learn, and that you can start putting a plan in place. So before we go any further, I want to launch a poll anywhere, just so that I could get a gauge of, you know, like who's in this class today. Like, so if you should see that on your screen. So it says, please tell us who you are. And so if you could take a moment to do that, that would be really great. Okay, we still have a few more people to respond. Okay, we have a few more still responding. Okay. Okay, so I think we have it shaped. If you mind kind of like showing the results, that would be great. Are you able to do that?
I can share a screen of it. Yeah, I would just have
I
to
think
take
you just have to
over.
click share results.
Oh, here we go. Yep.
Okay. Okay, so are you guys able to see the results on your screen? Perfect. So it seems like 43% of our participants are Milgard students, 4% student here at UW. We have a few faculty members here, as well as a couple of alumni and a few community members and a few other. So, okay, well, so it looks like we have mostly students, but then we have a variety, so that's really good. So thank you for doing that. I really appreciate that. Okay, so if you could remove that shade, that would be great. There. Okay. So um, there are many different ways that we could start on our financial journey, but I think it's really good to start with setting some financial goals. And so here, I just want you to kind of think about your own personal needs, your values, and your life situation. And now I want to ask you, like what's important to you? What matters the most to you? What are you hoping to achieve with your money? So if you have a piece of paper, or perhaps you could open up a blank document on your computer, I want you to take a moment to write some of them down. And also, if some of you don't mind sharing, if you could type some of that in your chat, that would be really great too. And while you do that, um, I just want to kind of like share with you the kind of like the journey, which process which my husband and I went through when we did this in our 30s. And so um, we kind of approached it as like a brainstorming section. We talked about many different things and just wrote everything down. I mean, like we didn't try to, like revise it or to, try to make it perfect. We just got everything down on a piece of paper. And afterwards, what we did was we looked at them and then categorized them into three different buckets. One, we call them essential, that we must do. And then two, they're very important, but then not that essential. I mean, they are essential, but then they're not as essential. And then my third bucket was, it was nice to achieve, but not important right now, not that important. And we did it this way because it allows us to see and to discuss what was important to us. And through the process, we actually learned a few things about ourselves and about each other, and also different types of value that we have when it's surrounded money. And so it was a very interesting exercise, but then, it allowed us to kind of like put it all together, and we compromised and we came up with shared goals that was going to work for our family. So let's see, we have one here. Matthew share that I need to be able to provide for my family, number one. I want to give back to those who have contributed to my growth as an individual. And I want to share my experience and lessons with others in the future. And that's your bigger picture. That's great. Thank you for sharing. Amanda says, financial security, being able to pay my bills and slowly save up, retirement planning, goal for home ownership, and being able to give back to the community and help others. And then Kathy says, want to not outlive my money. That would be very nice. Yes, thank you for sharing all that. I really appreciate it. So now, like after you have done that exercise, and hopefully, I mean, like you do take the time to do that, because and sometimes, like if you have a significant other or a spouse, it's kind of good to do that together, because just like I share with you about my journey with my husband, is that we did learn a lot of things about ourselves, and there were some conflicting values which we really had to work through, and we continue to work through some of those even today as well too. But when we set financial goals, now that we have some broader pictures out there, and then we know what some of them are essentials and not essentials, but then nice things to achieve, things like that, we want to take a smart approach to actually building our goals. And there's a 5 criteria that should be incorporated into each of your goals. And that is S stands for smart, M is measurable, A is attainable, R is relevant, and T is timely. So let's start with the S. We need to be very specific about our goals. We need to know exactly what your goals are. So for example, I want to be, let's see, let me look up this. It's like, I want to be able to pay my bills and slowly save up. So what does that look like? Could we make it a little more specific? Maybe you could say, I want to save up 6 months worth of monthly expenses, or something a little more specific like that. And then measurable. We want to attach some monetary value to that, because this is a financial goals. And so maybe we want to say, 6 months, what does that equal? Maybe like I want to save up, $8,000 or something like that, or some dollar figure. And it has to be very action oriented or attainable. And so, like, what are you going to do? So for example, let's say like I want to be able to save up money for my child's college education. You want something that's action oriented, such as like, I'm going to open up a 529 plan and save X dollar amount per month or like per year towards that goal. And then third is irrelevant. It has to be based on your income and your life situation. So for example, if you want to retire in Florida, does it make sense for you to buy a second home in Montana? Maybe it is, or like maybe it's not. But then just kind of think about whether those goals are relevant to you. And then lastly, we want them to be time-based, meaning that we need to have a time frame for achieving those goals. Is it a short-term goal? Is it a mid-term goal? Or is it a long-term goal? Okay, so I have an example here for you. So since most of the participants here are students, one of the goals might be to take a trip for spring break. I'm sure many of us have done that in our life journey, right? And so like a specific would be, a plane trip to Hawaii on spring break. And then I want it to be measurable. It's going to cost $2,500 for a 5-day trip. Now, is it attainable? Is it action oriented? It's like, I need to save, or I want to save $250 a month for 10 months. And is it relevant? Yes, it's important to take a break and to just kind of like rejuvenate, or maybe you have some other reasons besides that. But I think it's important to take a break every once in a while too. And then for timely, for time-based, it's a short-term goal that she wants to achieve, because she wants to do that within a year. Okay, and so this is an example of like how we actually build a SMART goal. But at the same time, how am I going to achieve this goal? Now, in the previous slide, I mentioned that in order to achieve this goal, I need to save $250 per month for 10 months. How am I going to do this? Now, if I have enough surplus in my budget, I could just probably allocate some of that surplus toward this goal. But then if I don't, maybe, what are some of the things that I could do? And here are some suggestions, work more hours to increase my savings, or cut out extra expenses, or like research various ways to save money on my trip, or like maybe instead of getting that Christmas present, you could ask for money for your Christmas from your grandparents, or things like that. I mean, just be really creative with that. I mean, are there some other, other tips which you guys have in terms of like how to save more money? Can you guys give some examples of that?
I'm sorry, repeat the question one more time.
Can you give some other, examples of like how you could achieve something if you don't have a surplus in your budget to be able to achieve, like saving, towards the savings goal?
So one of the strategies that I use to save money and to not spend a lot is I only take out $100 each payday, and my bills are automatically deducted from my bank account. And so other than that $100, I won't spend anything past that, going shopping and stuff. And then after that's done, when I take the next $100 out on my next paycheck, I just drop the extra in a piggy bank.
That's great. You're very disciplined. Yeah, just making it automatic. That's really great. Yeah, great example. Somebody wrote here, downsizing. or cutting unnecessary spending, or having part of your money go directly from your paycheck into savings that you don't access often. Another very good idea. Just make those savings automatic, right? Yeah. So let's see, not eating out, track your spending, being aware of automatic deductions. All very good stuff. Yeah, thank you for sharing. So now that you have your SMART goal, I mean, we talked about how like your goals have to be time bound, right? Timely. And so we want to be able to, like categorize, our goals into whether they're short-term, intermediate goals, or on long-term goals. And this is going to be different for different people. It's not a one size fits all. And as your life stage changes, you should probably adjust those things as well too. Now, I like to use this category. For my short term, I like to use 2 years or less. For intermediate goals, 2 to 5 years, and for long-term goals, 5+ years. Now, there are many different ways of categorizing this. Like some people may categorize short-term as those things that you want to accomplish in maybe like in the next 12 months. And maybe your long-term goals, maybe you want to take that out into maybe like 10+ years. I just like to keep it into 3 buckets. I like 3-bucket rule a little bit. And so this is how I like to do it. And so I want to share this with you. But again, you're welcome to categorize it in a different way, which kind of fits your lifestyle. So like short-term goals, it says that these are things that you want to achieve in 2 years or less. These are things such as like, which I saw in the chat room earlier, meeting day-to-day expenses. It might be maybe like, paying down on your credit card debt, or maybe like building an emergency fund so that you could meet those unexpected expenses as they come due. What are some other things that you could think of that may actually go into short-term goals? Maybe for some students, like I'm currently teaching 2 courses right now. A lot of my students are actually graduating after this quarter or like after next quarter. And one thing that's on their mind is, purchasing a car, because like they need a car for their career, for their jobs. And so maybe saving for a down deposit or down payment on your vehicle might be on one of those goals as well too. Okay. And then for intermediate goals, maybe like maybe like you want to, like start being more aggressive about paying off some of your debt. And maybe like, you can accomplish that in your, as your short-term goal. And so maybe you want to keep that as your immediate goal. I'm sorry, intermediate goal. Or like maybe you want to start saving money for a down payment on a home. Or maybe for some people, maybe instead of being intermediate, maybe that's a long-term goal for them. Okay? It just depends on where you are in your life stage. And some of the longer term goals, it kind of goes without saying, is, like retirement. I mean, that's our long-term goal, right? We want to have financial security as we near retirement. But some of the other ones might be, I want to pay off my mortgage. Maybe like I need to, if you're very young and you have, and you're starting out in your family, maybe saving for a college for your child or for another family member, maybe that might be some of your long-term goals. Okay. And in fact, I have many friends who are using some of the money that they saved up for their children. There's some money left over and they're using that money to go to college themselves because there's some money left over. And so as you can see, like when you plan for this financial events in your life, it gives you flexibility to be able to do things which like without having to worry about how I'm going to pay for these things. And so I just like to use this kind of a time frame. But again, like I said before, it may look differently for you. Okay. Any questions or comments so far? Okay, well, let's get going. So like if setting financial goal is kind of like a roadmap that just kind of guides you along the way, budgeting tells you how you're actually going to get to your destination. And most people don't budget because they think that it's too hard or not necessary because they just don't have enough money. And so therefore, what's the point of budgeting? Well, budgeting helps you understand how to spend your money, and it place your high priorities at the top of your spending list. And I think budgeting is very easy to do. You simply, step one, you earn money, right? And then step two, you take the money you earn and you spend your money. So you want to be able to track your spending. And then step three, if you have money left over at the end of each period, whether it's a month or a quarter, then you save that surplus and then you invest to actually make your money grow. And so step one says earn your money. So to get started, you need to understand your sources and uses of money, right? And so, so we need to understand, like where's our sources of our income, and also where's our money going. So we need to understand that. So so before we start doing all of that, what I like to do is I like to gather all my bank statements and all my credit card statements, because I do put a lot of my expenses on my credit card. Or if you don't, you could look at your bank statement and you can see where all your money's going. Or if you don't, maybe just for maybe a month or two, just on a piece of paper or on some spreadsheet, just track all your expenses for a month or two and to see where all your money's going. And so therefore, you want to have at least 1 to 2 months worth of activity. If you have more than that, that's even better, because in that way you should be able to capture those things, such as maybe certain payments you only pay once a quarter, or maybe certain things you pay once every 6 months. So for example, car insurance, I pay that once every 6 months. Okay, so now you have all of this information in front of you. And so now we're gonna take that step one. It says earn your money, right? We're gonna write down all your basic income. And what I mean by basic income is the money that you could count on every single month. You could get this information from your bank statement or your pay stub. If you're self-employed, or maybe you do contracting work, you could include those as well. And so therefore, or maybe perhaps your parents, because you're a student, you get allowance from your parents. Include that into your basic income as well. And we're focusing on after-tax income. Okay. And then step number two, we want to be able, we need to know where we're spending our money on. So again, take your bank statement and your credit card statements, and then write down, all your expenses that you see on there, and not just mentally visualize where your money is going, but then physically write them down. You could do it on a piece of paper. I like to use an Excel spreadsheet. Some of these expenses, many of us have either rent or mortgage payment. We might have car payment or car insurance payments, utility expenses such as your electricity, garbage, water, etc. How about gas for your car? And you could see, what your average, spending is on gas, or maybe groceries, eating out, gym membership, Netflix, Hulu, or even your cell phone bill, if you're responsible for and paying for your cell phone bill. So just make a list of all your spending and just kind of see how much you're spending on all of those items. And then once you have all of that, now we're ready to build a budget. Okay. So here, let's see. I just want to say that there are many budgeting techniques and apps out there. There is no one technique or app that's the rule or a must use. Is whatever that works for you. I know a lot of my students, they like using budgeting apps that they get from their, such as Mint or Personal Capital, or and there's some other great apps out there. They're not coming to my mind. And also some people actually like the budgeting feature that comes with their bank accounts. So you could go to your bank account nowadays. I know I have it with my bank account too. You actually feature some budgeting features, so you could categorize, how much you want to spend in certain areas. What are some of your favorite apps that you use? It looks like Celeste said that she likes Buddy. Is a great budgeting app. Now that's one that I've never heard of. Okay, so thank you for sharing that. I enjoy Every Dollar by Dave Ramsey. Okay, I haven't heard of that one either. Wow. Okay, so I'm actually hearing some new apps that I haven't heard from my students previously. So that's great. Yeah. And so whatever it is, like I mean, like that's what I want you to use. That's gonna work for you. But today, I want to take you through the proportional budgeting technique called the 50-30-20 rule. This is a very popular a budgeting rule. I think that was championed by Elizabeth Warren, and I know like a lot of different like financial websites as well as financial planners like to use this, and it's very simple and it's very intuitive, and it works like this. So basically, you take 50% of your after-tax income and you allocate that towards your essentials. And what I mean by essentials is things that you cannot live without, or bills that you cannot avoid paying. And they could be like your rent or mortgage payment or your car payment. I mean, if you have a loan on your car, you have to make that payment, right? Or groceries or like insurance or like utilities, things like that. Okay. And the next category is lifestyle choices. These are your wants, or the things that actually makes your life more fun, if there's such thing as more fun. Yeah. Or another way to think about it is like, these are the things that you could live without. It just enhances your life. And it may be things like, movie nights out. I don't think we're doing too many movie nights out with the COVID right now, but then, previously, I'm sure you did a lot of that. Or concert tickets or sporting events, having the latest technology gadgets, kind of things like that. These are the things that enhance your life. And the last category is 20%, and that goes towards your savings or your financial priorities, or like what I like to call financial goals, such as setting up an emergency fund, having a retirement account. If one of your goals is to buy a house, having a savings goal to actually work towards that down payment for a house. Okay. And so these are the three buckets which I like, and I think it's very good. 50-30-20 rule. Now there are variations to this rule. Like you may be there are variations such as like 60-20-20 rule, or like 70-30-20-10 rule. But I think the most popular one is the 50-30-20 rule. And so from the previous exercise, like you wrote down all your spending, and so you know where all your money is going. So now you want to categorize them into these three different areas. And so you need to determine whether each of your spending, I guess like based upon what you have. Some of the things are going to be really easy. You should be able to immediately see that some of the things are essentials, and some of the things are maybe like like lifestyle choices, things that are nice to have. But then some things may not be so clear, right? And so what you need to do is you need to look at all your like list of all your spending, and then categorize them, and then really ask yourself, is this something that's a need or a want? And also whether that thing is a need or a want is going to be very personal to you. So like I'll give you an example using my son. I love using my son as an example because he's such a character at times. He thinks that having the latest iPhone is a need. I don't think so, but then he thinks so. And so therefore it's very personal. And then we really need to, like ask ourselves, is that really a need or a want? And for some people, it might be a need, but for some people it may not be. And so, what are some other examples that you could think of that may actually fall into a gray area? A new car, definitely. Doggy daycare. Oh, okay. That's really interesting. Okay. Yeah. Thank you for sharing that. I didn't think about doggy daycare. This is the first time that a doggy daycare actually came up. Yeah. Daily Starbucks coffees. I'm gonna admit it to you. That's one of my vices too. I enjoy going to Starbucks, but instead of ordering coffee, I like the pink drink. I don't know why. I love that drink. Yeah, it just tastes so good. Yeah. Let's see. Matthew says, "Is the price I'm paying for whatever appropriate? Maybe it's a need, but can I pay less?" Okay, that's really good too. Yeah, like some of the other examples, like new car is a great example, and the reason why I say that is because my daughter just bought a new vehicle over the weekend, and then we really had to decide, like do we want a new car, or like do we want to buy a used car? And we ended up buying a used car because it just made more financial sense for her based upon her stage in life, how much she could afford. And basically, we just determined that she really doesn't need a new car. And then she came to agree with us at the end that she doesn't need a new car. So, but then, like some of the things that, we all have our clothing budget because, we all have to go to work, or like maybe like or like maybe I'm like we need to go out for a certain event. And, proper presentation is important. But at times, like even though clothes are a need, we know that they could quickly fall into a want category, right? Transportation is also very important, whether you take the bus, a car, or an Uber ride. But then we also know that this could also, quickly fall into a want category. So for example, my son, he could walk to school. It only takes 20-minute walk, but sometimes he prefers to take an Uber ride because he just doesn't want to walk. And so we have to actually talk to him about that. He thinks it's a must, and the time that he saves, is actually worth it to him. And so my husband and I are still continuing, like work to kind of like mold his mind a little bit to try to kind of like help him recategorize, what actually is a need versus a want. How about Netflix, Disney Plus, ESPN, Hulu, and some other subscriptions? How many subscriptions do you have? I think I have like 4. And I think to be honest with you, I don't watch all of them. And so maybe like I need to sit down and say, like, do I really need all these, right? So therefore, sometimes we have those gray areas too. And how about gym membership? I personally think exercise is very important, and also staying healthy. But if you're not using it, perhaps maybe we shouldn't be paying for that, right? So this is going to be a very personal exercise for you as to how you categorize that. So like after you do all that, what do I do? Take a look and see if you are within the percentages for each category. Now, if your spending is disproportionate, then maybe you may need to make some adjustments. And if you do, move things around. Perhaps some of the items you have indicated as essentials may actually be lifestyle choices, or vice versa, right? Or like if you're over budget, perhaps you could trim your spending on essentials, shop around for better rates or your cable, or maybe even cut cable altogether, or maybe on your phone plans. Or a big thing, I think, is shopping around for car insurance, right? Or maybe look at different affordable housing options. For example, if you're single and you're living in a 2-bedroom apartment, could I downsize to a 1-bedroom apartment? I mean, like look at what your options are and see what is possible within your budget. And also review your spending on wants. Maybe, somebody mentioned it previously, maybe I could spend a little bit less on eating out, or maybe, like example that I used before, do I need 5 different online streaming subscriptions? Some of these expenses might be really small, but over a period of time, they really do add up. I know that like when I'm out with my friends sometimes, it's $20 here, $30 here, $40 here. But then when I look at my overall spending for the month, they really do add up, and they add up quite quickly. And so you want to spend your time and just kind of look at it and see, like I'm like, do I need to move things around? Could I do a little bit better here? And I mean, like, could I shop around for like certain discounts? It says some offer student discounts or your streaming subs, etc. And so, just kind of explore those options, okay? And if you're not perfectly within 50, 30, 20, it's okay because you're starting. And so therefore, I think want to try to get to a certain place. Okay. So I just have one more slide that I want to do before we actually go on a break. And I want to talk about, so what do I do with my budget once it's created? I actually read on the internet that people go through this whole exercise of creating a budget and then they file it away or they put it away and they never look at it again. Well, that's not what we want to do, right? I mean, like we want to be able to track it. I mean, that's the whole reason why we're creating a budget. And so therefore, if there are any new transactions or maybe I mean, like check your even scheduled transactions and see how you are doing against your budget. Maybe you got a raise from your work, or like maybe you have a new income stream. Budget those things into your budget. And also make adjustment categories as your lifestyle changes or as your life stage changes. The whole idea is to be flexible and to use your budget as a guide for your decision making. It's not something, like that is like, set in stone that you must follow this. You want to make it flexible enough so that it helps you towards your goal. And some months, you may not make it, but then overall, we want to see that trend of you actually like keeping, like sticking to your budget and keeping track of your budget and things like that. And the key again is to be flexible. Okay. And it looks like, let's see, we're right at about 45, 50-minute points. So I'm going to take a 5-minute break. And so it is 2:46 right now. So let's get back together around around 2:50. Yeah, let's take a 4-minute. No, let's get back around like 2:55. I'll give you guys a 8-minute break. Okay, is that good? Okay, so I'll see you back at 2:55. Okay, thank you, everyone. Okay, thank you everyone for coming back. So we have a question in our chat room. Matthew asked, I'm just curious, not that you have to share, but what do you like most about the way you do a budget if you do one? I do one, and it's something very similar to what Aubrey does. Um, I don't personally use any apps, and for some reason, I have this aversion to giving out my bank information or my credit card information and I'm linking that. And perhaps maybe they're safe, and maybe one of these days I will go over, get over that aversion. But for now, it's something that I've always done. Is like I like to use an Excel spreadsheet, and I can make it as simple or as elaborate as I want. And I just jot everything down. And then on top of that, I have like another a worksheet tab where I just list all of my upcoming expenses, just so that I could track, what's coming up. Because my husband and I also have a separate business besides our income. And so we have to budget for self-employment taxes and also for, like quarterly estimated taxes. And also we have, I still have a child in college, so I have to budget for their tuition payment, and they happen every quarter. And so I have a separate spreadsheet so that I know what big, expenses are coming up. And just like Aubrey says, it really is satisfying, at the end of the month, if I spend less um, um, than in certain categories, because instead of spending that for something else, just like Aubrey does, I actually try to save that. But just like one statistics that I read just this week in Wall Street Journal this week, I guess like somebody took some kind of poll. It said that 7 in 10 Americans plan on overspending on their Christmas gifts this year. You know, that's a budget buster, is it not? I don't know if you guys budget for, certain, holiday expenses, or maybe like, or like maybe like a birthdays or like wedding, things like that. But then those things are somewhat of a budget buster, are they not? I mean, how do you guys budget, and also how do you account for those types of expenses, like holidays and birthdays and things like that? If you guys don't mind sharing.
I'm sorry, what was the question?
Like sometimes, we have expenses that are, I'm not talking about, like unexpected, but then we have a holidays coming up, right? We have like Thanksgiving and like Christmas and like New Year's and things like that. And then in the recent Wall Street Journal article that I read, it says that 7 in 10 Americans plan on overspending on their holiday budget. And so I'm just kind of curious as to like, do you, when you budget, if you budget, do you account for those kind of things?
Right. So I look at it the same way I look at car maintenance. I create a sinking fund where I'm contributing $50 or $100. Obviously, for gifts, it's probably something more like 10 or 15.
Mhm.
But that's periodically through the year, to where a kid's birthday, maybe it was expected, it was scheduled, but I completely forgot. And if I have to pull from it, I run out to the store and I feel comfortable buying whatever gift I decide to, because I have those funds allocated.
Right. That's really great. Yeah. Like the one thing I do with my budget, like Celeste asked, like, can you share your Excel budget? Probably not, my Excel spreadsheet, because there's a lot of personal information on there. But like what I also do with my Excel spreadsheet budget is like, I could look at my whole expenses for the whole year. And also I could see, like what did I spend, last year on my holiday? What did I spend for like Mother's Day? What did I spend for Father's Day? Because I have a very big family. And so as I kind of take that into account when I do my budget for the next year. And so that's how I use my budget in that way as well too. Shane says, sometimes my family just loves my company and sentimental home, make gifts and cards more than store-bought items. Oh, that's really nice. Yeah. Let's see. Amanda says, I make a plan and I start buying since November. That's great. So you kind of like spread it out, right? And that's another great plan as well too. And so which kind of, Aubrey also is sharing that for holidays and birthdays, I set some money aside every month. Then as we get closer to the holidays and birthdays, we have a lot in December, January. My husband and I plan together a budget so we can try to keep track of the gifts we're buying for our son and our parents. These are really great that you guys are actually doing that. But in fact, that's not the reality in America. A lot of people in that same article that I read, when they asked, how are you going to pay for those holiday gifts? They said they plan on putting it on the credit card and then pay it off slowly throughout the year. And that was kind of like the number one answer that the article actually gave. And so hopefully, when we actually, plan for our spending, and also we have a budget, and also and just like Daniel said, and just as Aubrey said too, have money set aside for things like that. We don't fall into that trap of putting everything on a credit card and also not paying it off every month. Okay. So, like this takes us to our next slide. And basically, I just want to say that savings is very difficult because expenses just kind of creep up on you, do they not? I know that when my children were younger, I just felt at times, we were so up to our head in expenses that it was really hard to find money to save. And so therefore, we have to think about some different saving strategies so that we can make savings more automatic or more consistent. And one thing that I think is really great, which I do, and also which a lot of financial advisors recommend, is that we make savings automatic. So for example, set up a payroll deduction for your 401k. Just make that automatic. Split your direct deposit. So a portion of every paycheck goes into your savings account, and so a portion goes directly into your savings account, and the rest into your checking account. Or like if your employer doesn't give you that option, which I think most employers do, but then if they don't, you could set up automated transfers between your checking and your savings account, so that every month it just transfers over, like whenever you get paid, a certain amount every month into your savings account. And nowadays, these are so easy to do with our mobile and like online banking and different apps that we have, right? And another thing is maybe, we could commit to saving, our bonuses, or like 50% of future raises towards your savings goal, so that we don't get caught up with what's the terminology called lifestyle creep, right? Do you guys know what I mean by lifestyle creep? Yes, no. What a lifestyle creep is like as your earnings increase, our expenses and our lifestyle expenses actually increase along with it. However, if we make these savings from our bonuses or our future raises automatic to actually have it directed towards our savings, it actually, helps in actually, achieving some of our goals. So besides these two that I have here, what are some other strategies which you could think of, or like perhaps you have used previously to try to save more?
I really like percentages. So when I look at my overall income, I say no matter what my income is, what is a savings rate that I can maintain consistently? And so I set up a percentage to where if that income fluctuates, I'm always set on that percentage.
Wow, you're very disciplined. That's great. Thank you for sharing. Anyone else? Let's try to get one or two more comments in here. Let's see. Shane says, I don't pay for parking. I'll walk. I'll try to cut costs when I can, especially if I can get more exercise. A great idea. You're working on your expenses as well as working on your health. So that's really great. Amanda says, I like having an expense sheet so I know every bill that comes up and is due. I go through my subscriptions like Netflix, and what doesn't get used, I cancel to save money. Another great example. I actually need to encourage my husband to actually cancel his LA Fitness membership. I think he only goes like once a month. And so, yeah, so like, yeah, things like that. I mean, we do need to really look at closely, right? Yeah. So, how about selling some stuff that we have around our house? Um, um, I also want to let you know that I'm licensed real estate broker as well too. I'm a realtor, and I actually, help, my clients with their buying and selling decisions. And one thing that I do is like when I meet with the sales, on the selling side, is like people have so much stuff in their house, right? And what they do is like right before putting up for sale, I encourage them to try to cut back on everything just so that the house just looks really good when a potential buyer comes through. And I recommend that if they're not going to take something with them to their new house, just sell everything, sell or like donate everything. And it's amazing when I watch them how much fun they have selling their stuff that they found out that they actually don't need. And whether you use Facebook Marketplace or like OfferUp or like other types of places, it is, I mean, it's another source of like income which you could put towards your savings as well. Yeah. And I see that more often than not. Yeah. Amanda also says, oh, Celie says, yes, I'm trying to sell my stuff. And Amanda says, I save on clothes as I have no issue buying good stuff from Goodwill and Value Village. And where do you sell electronics and others? I don't think I'm an expert on that at all. Shane says OfferUp. Okay, there you go. Yeah, Shane is our IT person, so I'm sure he knows. Yeah, and Amanda also says Fiverr. Okay. Oh, I heard of Fiverr before. Okay. And so these are all really, really great ideas. And so if there are like other ideas that you have, like feel free to share with other people that are here. Next, I just want to kind of switch gear a little bit and talk about financial ratios, because there are some key financial ratios and benchmarks which we should aim towards. And a lot of the times, my students would ask me, what are some important ratios? Like, how much should I really be saving and things like that? And financial ratios and benchmarks are essentially just relationship between some numbers, right? And what they do is like they provide you with a snapshot or a picture as of a certain point in time of your financial well-being. And first one is a current ratio. This is your liquidity ratio. What do I mean by that? It's your current assets divided by current liabilities, or to put it another way, for those of you guys who are not accounting majors, is your liquid assets divided by your monthly expenses. So what are my liquid assets? That's the money that you have in your savings or your checking account. But it could also include items that you have in your money market funds, or those other items that you can quickly convert it to cash if you were to sell it if you needed to. And on the bottom is current liabilities. These are your monthly expenses. At minimum, you want to include your essential monthly expenses that we talked about in our 50-30-20 rule. And you want this ratio to be above 1, but ideally you want 3 to 6 times your monthly expense. Like Daniel brought up a point about earlier about how like he saves for those unexpected expenses. That's what an emergency fund is. And you want to target anywhere between 3 to 6 months of your monthly essential expenses. And basically what this does is it gives you a peace of mind when those unexpected events like expenses come up, such as like any birthdays or things like that, or maybe a car, maybe your car broke down, or like there's a leak in your roof, or maybe you just experienced a sudden job loss, or maybe there's a large medical bill. And this is really important because the National Financial Literacy Committee found out that 30% of Americans actually struggle to come up with $400 of unexpected bill. And just recently this week, I read on CNBC that just 39% of Americans could come up with $1,000 of unexpected bill. And so this is just really important that we understand, just the importance of building up an emergency fund. And so again, we want to target at least 3 to 6 months of savings for emergencies. The next two ratios, the housing to income ratio and total debt to income ratio, are very important because those are the two ratios that the financial institutions actually look at when they're qualifying you for a loan. So for example, housing to income ratio, what does that mean? Let's see, it says here, okay. Now this ratio shows you how much you could afford to spend on your home. Like whether you buy or you rent your home. And your housing costs, your monthly housing costs include things like your rent or mortgage, property taxes if you own your home, insurance, utilities. And like if you live in a condo, maybe HOA dues, those are also included as your total housing cost. And your income we're talking about here is your gross income. And which means before any deductions for your retirement or your taxes. And ideally, you want to keep this ratio below 28%. Because like I said previously, this is one of the determining factors when you're being qualified for a home loan. Another important ratio is the total debt to income ratio. And this shows your ability to repay debt when they actually come due. And so on the numerator we have is your total debt payment. And these include, again, everything from your housing payment plus all your other debts that you have, such as if you have a student loan, you have a car loan, or like you have credit card loan, or maybe like other types of consumer or like personal loans, or a HELOC loan, home equity line of credit. And so therefore, these are going to include all of that. And again, the income is your gross income before deducting for any taxes or for any other types of deductions. Now, I want to talk about another benchmark. We're going to talk about net worth in the next slide, but before we do, I want to talk about another benchmark, and that is your savings target for your retirement. Because we all know that we should be saving for our retirement, but we really don't know how much should we save. And there are many different, ways of calculating that. Some people say that you should have 8 times your monthly salary right before your retirement, or like 10 times your monthly salary. And then, but then here's another guideline, and it's like you want to target, certain percentage of your income. And so, like if you're less than 30 years old, because you have time on your side, you want to be targeting around 20% of your income towards your long-term retirement or towards your long-term goals. And then if you're between 30 and 40, you want to increase that. I mean, if you're starting before, between the ages of 30 and 40, you want to target somewhere around 15% of your income. And then if you're starting to save for your retirement at 40 or above, then maybe you may be looking at maybe like 20% of your income based upon your current income level and the type of lifestyle that you want. And so, I mean, this may vary depending, like I said, depending on, your lifestyle or that type of lifestyle that you want to have in your retirement. But this is just a guide. It's just a benchmark for you to kind of like start thinking about in terms of how much should I really be saving. So do we have any questions so far regarding these financial ratios? Okay. So what if and so like like I'm really young. I'm in my early 20s. I'm starting out in my career, and I want to start saving for my retirement. But my company doesn't offer a 401k. What are my options? Well, that's you could open up your own individual retirement account, whether you open up a traditional IRA or a Roth IRA. You just want to start by contributing, what you can. There is a maximum limit, but like if you could just start with how much you could afford, whether it be $100 per paycheck or $50 per paycheck. The important thing is that you start. And so like, yes, I don't have, 12% to actually, go towards that goal. And so the important thing is just to start. And if your company does offer a 401k and at least contribute up to the matching amount of what the company matches if the company does matching, because that's free money, which you don't want to just leave on the table. So now I want to move to another very important ratio, and that's your net worth. We looked at the debt to income ratio before, but the net worth gives you a more broader perspective. Because it looks at your overall financial health, and it's defined as your total assets minus total liabilities. And we're including all of your assets and all of your liabilities in here. And so what are my assets? That's the market value of everything that you own, such as your car, your house, your retirement savings, stocks, bonds, jewelry, your computer equipment, etc. Anything that has a market value associated with it. And your liabilities is the amount that you owe, such as before, like the credit card debt, mortgage, student loan, car loans, or if you took a loan out from your retirement account, like loans from your retirement account, etc. And so you start with the total assets, you subtract your liabilities, and then hopefully you have a positive net worth, right? That's our goal. We want to have positive net worth. But it's okay if you find out that you have negative net worth, because it's good to know where you're starting from, right? And also, especially when you're young and just starting out and you're out of college, it's very common for you to have a negative net worth, because you might have student loan, you might have a car loan, and if you're in the early stages of your career or like early family stage, you might have a mortgage loan or maybe other consumer loans too. But then ideally, you want to be able to see your net worth increase over time, not decrease. So it's a good idea or a good practice to actually calculate this ratio periodically, at minimum, either quarterly or annually. Now, I know that we have some individuals in our audience from various financial institutions. So I'm wondering if somebody, if anybody will be willing to share their thoughts on this financial ratios in any way, if they could add anything to that. Or if anyone is willing to add anything to this, yeah.
I'd be happy.
Thank you, Jennifer.
Yeah, absolutely. I think you're 100% right. When you're younger and you're, graduating from college, you may not see the positive net worth that you're hoping to see, but knowing that you're young and you're starting out in a career, you're going to have the opportunity to change that around, start putting into a 401k, paying down some of your debt. And as you're setting financial goals or budgeting, like you've been speaking about, that will all help you in making sure that you can really start to grow that net worth. And paying yourself first is extremely important if you have the opportunity to do so. So even if it's just 10% of your paycheck, putting that in towards savings, investments, things to that extent will really help you to prepare and grow your net worth.
Thank you, Jennifer. That was really good. Yeah. So just like Jennifer said, it's just really important to just start and to just, just to understand where you are, but to understand that you could improve that. And really, if you have your financial goals set and then you have a budget, and then like if you could see that trend over a period of time, and if you see your net worth growing, give yourself a pat on the back. That's a good start. Okay. So I want to talk about human capital a little bit. Many people will say that all debt is bad, but not all debt is bad. And so therefore, because sometimes we have to take on debt to increase our human capital. And if you look at the definition here, human capital, there are several definitions to it. I use this. It says that it's your ability and willingness to work, learn, earn, and make wise decisions about how to save and invest money. And so basically, there are certain times in your life where you want to invest in yourself to actually increase your human capital. And any debt that is an investment in your human capital, that's actually good debt. And some of those things maybe for, you take out loans to pay for your education or your related transportation and things like that so that you could get to your job. A bad debt, by contrast, would be something like you borrow your money to buy something that either goes down in value quickly or is consumed immediately. Such as getting that new iPhone that costs $1,200 every year, right? Yeah. But then over the course of your life, what you want to do is like what you have invested in yourself, you want to convert that to earnings or like into some other forms of wealth, such as like retirement savings, real estate, or like other assets, or like maybe, increase in your earnings, right? And also, and this reflects as a natural progression as you journey through your life. So for example, here, early in your career, your human capital increases because you're gaining additional education or training or like experience. And as you continue to gain those experiences and education, your human capital starts to grow and it becomes very increasingly valuable. And then over time, like as we go through continuing your career and the retirement, your human capital may slow because you have less time remaining before you need to or choose to retire from your career. However, if you plan wisely, as you can see from this illustration here, that as you age, your financial wealth also increases too, as you can see in the yellow box with the arrow going up. And at some point, you should be able to stop working and then rely on your wealth to hopefully provide you with support during your retirement. And so if you are, taking out debt so that you could increase your human capital, I like to consider that as good debt. But then hopefully, you'll be taking that investment and you'll be converting it to something else rather than, not doing anything with that. Okay. So does that kind of make sense, everyone? Okay. Did somebody say something?
Okay, sorry. I agree with that statement.
Okay, well, thank you. Yeah. Let's see, here's a question. Matthew say, how do you factor ROI, rate of return? I'm not quite certain if I'm qualified to actually speak to that, because obviously you do want to have a positive return on your investment, especially in your education, and that's going to differ based upon every individual. But I do know that there are some different calculators out there, depending on your course of study at the university, and also like whether you have an undergraduate versus a graduate degree. There are certain metrics that are out there, and perhaps maybe I should have prepared that slide, because I do actually teach that in my class, but I didn't prepare that for this particular workshop. But definitely, if you just have a high school degree versus a 4-year degree versus a professional degree, your return on your investment actually increases exponentially. At least that's what the study shows. Does that kind of answer your question, Matthew?
Yes, thank you so much. I appreciate it.
Okay, great. So we're almost coming to a conclusion of our workshop, but there are 2 things that I just want to re-emphasize here. First one is the importance of having an emergency fund, because having an emergency fund just provides you with that peace of mind, knowing that when something happens, that you have money set aside to help you. And also, when you do, you don't have to rely on other people, such as your friends or family, because if you have to habitually, rely on them, sometimes the relationship could get really difficult. But many Americans, they rely on their credit cards to actually meet some of those unexpected expenses. And credit cards carry some, we know that credit card carries a very high interest rate. And what is really, really sad statistically is that so many Americans also rely on such thing as payday loans, which carry almost 400% interest. And so therefore, I just want to emphasize how important it is to, just to start, having that emergency fund. And like, if you're not able to save for 3 to 6 months, just start really small. Just set yourself a small goal that you know that you could achieve. And that may be, like for the next 3 months, I'm going to try to save $1,000. Or like maybe for the next 6, and then maybe thereafter, I'm going to try to save 1 month's worth of expense. And just make it part of your savings goal. And another thing that I just really want to emphasize is that I really want you to start saving for your retirement now if you are not already. And then if you are saving for your retirement, see if you could increase your, if you're not maxing it out, see if there's room for you to contribute additional money towards your retirement. And the reason is because of compounding interest. And I'll show you that in the next slide. But then before I do, for some of you guys, students out there, I know many of you guys work, part-time or like full-time while you're attending school. And hopefully your employer does offer a 401k. If they do, it's great if you sign up for that. But if they don't, just remember that you could open up your own individual retirement account. If you don't know how to do that, please feel free to email me and I'll provide you with some resources to help you. And then if you don't know how to, start on your 401k, contact your HR department. They'll probably help you. Hopefully, they should help you with that as well too. But then if not, please feel free to email me. Okay, so I'm going to show you how compounding interest works. So we have this chart here. We're going to assume 10% return on our money. Okay, so I want you to look at this blue line here. So here, a 24-year-old invests $2,000 per year for 12 years. Okay, so she starts at 24 and then she starts contributing somewhere around here for 12 years, so around like 26 or somewhere around there. And then she stopped adding money in, but because of the compounding interest, her total still grew. And by age 67, she has almost $1 million in her savings or her retirement account. Now contrast that with another individual. She didn't start investing until she was 35 years old. And she put in $2,000 every year until she turned 67. But because she didn't start early enough, even though she put more money in, she still had less than $500,000. And this is the effect of compounding interest. And I just want to show you another illustration just to kind of like drive home the point a little bit. Here we have another graph. Let's see, let's say like you want to save $1 million in retirement by the time you're 67 years old. This chart actually shows the percentage of your paycheck that a 40-year-old would need to set aside, assuming 8% return on investment. And so basically you're 40 years old, you haven't started saving for your retirement, but then I want $1 million in my retirement account by the time I retire at 67. It says here that if you're making $40,000, and this is gross income, before any deductions for taxes or for other salary deductions, it says that you have to contribute more than 35% of your income to actually reach that goal. If you make $60,000, you have to set aside 25% of your income. And if you make $80,000, a little under 20%. And so you could kind of see, how much you really have to put in. If you're making $40,000 a year and you have to set aside more than 35%, that's a big chunk of your income to be actually putting aside to actually reach that goal. And that's why we want to start saving for our retirement early. I did this calculation on my, just my financial calculator using the basic time value of money concept. Let's say that you invest $250 a month, starting at age 25, 35, and 45. And also let's just assume an 8% average annual investment return. We know that in the past 10 years, S&P 500 index has been returning quite a bit higher than that. And a lot of my students, because the market's been so good, they think the market only goes up and then never goes down, which we know is not true, right? Because I mean there are peaks and troughs, but on average, let's say that like we could get 8% average return on our investment. If you start investing $250 a month, and when you're 25, by the time you're 67, that money grows to over $1 million. And then if you start at 35, it's almost less than half that, $443,000. And then if you start when you're age 45, it's 180 or a little under $180,000. And this is the power of the compounding interest. So the key is to really start early. Yeah. So hopefully all of you guys are, contributing to your retirement 401k or maybe a Roth or a traditional IRA. If you're not, the important thing is that you do start. And also like when you're just graduating and you start a new job, perhaps you may think that I just don't have enough money. Just like the saving strategies that we talked about earlier, just make it automatic, because if you don't see it, you don't miss it, right? And so like whether it's 5%, 10%, etc., just make that automatic and just make it a payroll deduction. And at minimum, what you want to do is you want to be contributing up to whatever the company matching is, whether it's 3%, 5%, or 6%. But if you could do more than that, that's even better, right? Yeah. So we're done a little bit early. And so in today's workshop, we talked about, many different topics, such as we talked about money mindset. We talked about setting personal financial goals, budgeting, some different saving strategies. We looked at some financial ratios and things like that. And I know that it's the purpose of today's workshop was not to go too much into details into all of those, but to just kind of give you like an overall view of what some of those things actually look like. And so hopefully, I provided you with a basic framework to get you started on your journey to a financial well-being. And so I just want to open up this time for any questions or comments or anything that you have to share. Let's see, we have something here. Oh, you're welcome. Thank you, Stan. Leon says, how long does it take you to make a budget and keep track of your expenses? And how can you keep that as a habit? Great question. What I do is once it does take a little bit of investment of time upfront, because basically, you do need to see, where all your money is going and to be able to look at that and to see how you could categorize those things. And so once you have that set, it literally takes me, if you look at it maybe once a week, I look at it and I update it maybe 5-10 minutes once a week. And then maybe at the end of the month, I may spend another 10-15 minutes just kind of seeing how I did as I track those. Does anyone else have any input to this question that Leon has? How long does it take you to actually track your budget?
Right. So my initial budget probably took me a month to really get into a flow. But then after that, I've been doing it for 5 years, and tracking my expenses, I do it. I look at my banks. It really becomes easy if you make it a habit to do it after every transaction. So when you make a purchase, go into your, well, again, it depends if you're doing a spreadsheet or a mobile device, but on my mobile device, I simply just plug in the transaction and it's in my budget, and it takes 10 seconds.
Yeah, it's very easy these days now with all of the online tools that we have. For me, I actually charge everything on my credit card. And so I know there are a lot of dangers to using credit cards, and that's another subject matter. But I like to do that because my credit card company tracks all of my spending for me, and I just have to take those categories and just dump it into my Excel spreadsheet. Here's some other great feedback here. Let's see. Amanda says, even if you can't save much right now, you can work on your credit rating, which will help in the future. I use a credit card and spend at Dollar Tree, and the fact I pay it back shows on my credit rating and took my credit rating to 750 plus. So by the time I'm older in my career, I have a good rate to buy a house. Exactly. Yeah. I mean, and you know, you're maintaining your credit score is one of those main fundamental important things to financial literacy. And I know I didn't cover that, but we hope to cover that in some future future workshops. And Kathy says, put everything on a credit card and pay it off each month, so you never pay high interest rates, but benefit from easy accounting fund statement. Another great, you know, just another great example as well too. And that's exactly what I do as well. So thank you, Kathy. So, you know, and we are planning on more workshops that will hopefully delve deeper into more specific topics. Like I said, today was just an overview, and then hopefully we could give you, you know, some tools you could use so that you can make, you know, better decisions for your own life situations. And here are some few topics which we are looking into, and so we will appreciate your feedback on like anything which you'd like to see. Like some of the things that we kind of like brainstormed about was like understanding student loan payments. How about banking basics? And we talked, I mean, somebody mentioned this too, your credit score and using credit wisely. Very, very important. Purchasing a car and car loans, home buying and mortgages. How about renters and homeowners insurance? I don't know about you, but then reading all those disclosures on an insurance statement is very confusing, is it not? Likely, I have a husband who really understands that really well, so he handles all of our insurance, but that's another area which I know that I could learn more about as well too. How about just understanding your taxes, you know, just basics of understanding your, you know, like what goes into income tax preparation, as how to categorize certain income, what is AGI, and adjusted gross income is a very important term for a lot of different things on your taxes. You know, one thing that my students have expressed to me a lot is negotiating your salary. I want some basic skills about how to negotiate my salary after graduation. And one of my other students, actually former students, actually emailed me because she started a new job and she wanted to know the difference between a Roth and a traditional 401k. So I gave her some resources in actually doing that, but I think that's another area which we could delve into a much more deeper. And saving for colleges, 529 plan. I know we have GET plans here in Washington State as well, and there are some basic features that are different. And another thing that I hear a lot about from my students is, how do I start investing? You know, my parents never taught me this. I mean, how do I start? And so, you know, like these are some of the other things. And I see some really great things also coming into the chat room as well too. And so if you could share those things with you, with us, that would be great. It will kind of like help us guide in some of the other topics which we want to bring to you as well. And so Shane, if you could put in the chat room, you know, the survey that we have, if you could, you know, just take a brief moment. It'll literally take you less than a minute or two to do the survey, and then, you know, just tell us who you are again, and also like, you know, what features you liked or like did not like about this workshop, and also just like the screen says, you know, what are some other future workshops or like lecture series which you'll be more interested in. And so if you could put that in the survey, that would be great. Okay. And then I will also follow up after this with an email with that link as well too. Let's see. And I just, if there's no more questions, I also want to end with this. This is our Center for Financial Wellness. Again, I'm Hui Suk So. I am a CPA and I have a MAC, but I'm also a professor here and a principal with the Financial Literacy Initiative at the Center for Financial Wellness. And my co-principal is Dr. Fei Lang. He's a PhD, also a certified chartered financial analyst and an FRM. He's the principal of the Wealth Creation Initiative here at the Center for Financial Wellness. And if you have any questions or comments, please feel free to email us. I have it up here. It's financialwellness@uw.edu. Or if you want to visit us on our website, I have a QR code here. Just scan that with your phone, and it should take us to our website. And hopefully, as we have more workshops for you, we will announce that on that website, as well as send you reminders as well too. Okay. So do you guys have any other questions or comments before we end the session? Well, thank you everyone for coming here. And when Leon asked, could we have the slides? Absolutely, I will email that out to you after this session is over. So thank you everyone. Have a nice afternoon. I see the sun out.